So today's educational session will be some of the rules for going over closing orders. We will just talk about a few trades that I also hold currently to give as examples for closing orders. I have currently just a few long strikes out there as well as a few butterflies. So we can kind of walk through that just to get an idea of how those apply with the rules, both individually. I don't think it will take us too much time, certainly for the individual strategies that we've talked about in the past and already recorded. This might be a slight repeat just because we've talked about those rules. But we do find we do get questions about this, right? Whenever we're in the room and you might see an alert come through. For those of you who are newer traders or maybe just newer to how our alerts are set up, you know, sometimes you get those questions on, okay, wait, am I opening this and I'm closing it? And we usually try and be very straightforward about that, but hopefully this will help out some with that hurdle, right? So let me go ahead and pull up my slides here. So rules for closing orders. In this video, we will discuss the rules to remember when setting up closing orders for your account. It is important to understand these rules, especially as a newer trader. This way, you do not make a mistake when closing out of a trade and can look to bring the capital back into your account. Of course, ideally with that profit, right? Every time we close a trade, ideally we're trying to do so for some sort of profit to lock into our account, plus the capital that we put in and invest in the trade to begin with. So that's what ideally we're looking forward to do in this situation as well. So we'll start off with net debits or debit trades, right? So for trades that you open as a net debit or as a debit, whether it's a single strike or spreads, right? Whether it's a debit spread, vertical wise, maybe a diagonal, maybe a butterfly, there are a few things to remember. So the first thing I like people to remember is typically you will look to close the trade out for net credit. To me, that's like one of the most important things, right? If you opened a trade for a net debit and you're trying to close it for a net debit, more than likely that's not going to follow through, right? You're just giving them basically more capitals for a loss. So you typically would not look to do that. Usually the brokerage platform would not allow you to do that. So they kind of try and put up those safeties for you. But it's just something certainly to keep in mind, right? So typically in net debit trade, you're looking to close out for net credit. Any strike that is bought to open will now be sold to close, right? So these are the abbreviations typically you'll see in the trade order whenever you're setting it up, which is why I kept it this way in the slides. So when you see something that's BTO, that means you bought to open that strike or that strike on the spread. And it will now become a STC order or a sell to close. And any strike that was sold to open, right? If you have it paired as a spread, so you have multiple strikes, any strike that was sold to open will now be bought to close or BTC. The third thing I think is important to remember is the difference between the debit you paid to open the trade versus the credit you receive when closing it out will be your profit. So if you paid $1.50 for a trade and you're closing it out for a credit of $2.50, that means the difference between those two was your profit on the trade. The credit you receive when closing out of a trade is the amount of capital you bring back into your account per contract, of course, right? When we're talking about options trades here. So if I opened that trade, that example trade, $1.50 for one contract, that means I gave out $150 of my capital. When I closed it out bringing back in $250 of capital. So overall, I'm bringing back $250 of capital back into my account, right? That's coming back in. That's a capital positive move. The difference, of course, is that $100, that $1 profit, which I've locked in. So now let's flip it over to net credit trades. And keep in mind, this is the general rule of thumb, right? We'll talk about a few exceptions as well. But for trades that you open as a net credit, whether it is a single strike or spread trade, there are once again a few things to remember. Typically, you will close out of the trade for a net debit. Now, this isn't always the case, right? So net credit trades have a slight rule to them depending on the strategy that's being implemented. For example, if it is an unbalanced butterfly for a net credit, which we'll talk about, and the strike or the price, the underlying price, gets close to that middle strike into expiration, and that's where it looks like it's going to settle going into the close, then you'll actually be closing out of the trade for a net credit as well. So that works out a little bit differently. And certainly if you have questions about that, I first recommend going back to the unbalanced fly video that we did. We definitely cover it in there. And so if you have any questions about it, certainly go back and revisit that video. But that might be an exception to the rule, right? It's technically a net credit trade that you open. And if the price does get back towards the middle of the strike, you have that insurance of the butterfly. And it's the butterfly portion of that trade that allows you to close out of it for a net credit as well. If it's a profit recycling trade, for example, for those of you who have taken that class or certainly have heard me talk about it both here in the training room as well as in the main room, you know, with the profit recycling strategy, we are typically looking to, in a way, leg into a trade for an overall net credit. And we talk about the different strategies that we do with that, the criteria that we look for. Certainly for intraday style trading, that's what helps keep us away from day trading. But with the profit recycling strategy, typically we're setting up trades that are naturally open for a net debit, right? When you open all the strikes together, it's technically a net debit trade. But because of what we've done with the trade, we've have it as a net credit, right? So we already have a guaranteed profit. Those trades as well, if you're looking to close them out the next day, typically will also be closed for a net credit, adding on an additional profit. So those are just some of the exceptions to the rules on why you would not close it out for a net debit. But on most standard trades, when it's a vertical credit spread or an iron condor or an iron fly, if you're not letting it go into expiration to expire worthless, then you are closing it out for a net debit. Any strike that was sold to open will now be bought to close, right? So if you're doing a covered call or maybe you had a naked put or call out there, right? If you sold to open that strike, you're now buying to close it. And of course, if it's a spread, that means any strike that was also bought to open is now sold to close. So you just want to make sure those match up. If it had an S in front with the O at the end, it's going to have a B in front with the C at the end, right? And vice versa. The B gets switched to a no. The B gets switched to an S. The O gets switched to a C, right? That's how you know if you're opening or closing a strike. The third thing to remember is the difference between the credit you received to open the trade versus the debit you paid when closing the trade will be your profit typically, right? So if I opened an iron condor trade for $3 and I close it out for $1.50, I pay $1.50 to buy back that spread, then I'm looking at the difference between $3 credit versus $1.50 debit as my profit of $1.50. Let's say I opened it for a $3 credit, but closed it for a $3.50 debit. Well, that means technically, right, it's not a profit, it's a loss, and it's a 50-cent loss because I'm having to pay back more to close it out compared to the credit I initially had when I opened the trade. So that's how you determine whether or not it's a profit or loss there typically, right? Unless it's one of those exceptions I mentioned, that's what you're looking to do. Now, of course, the difference between the debit you paid when it's a spread in particular, right? So the difference between the debit you paid versus the spread width is the amount of capital recycled back into your account per contract. So if I, in this example, had a 5-point spread with that $3 credit and I closed it out for a $1.50 debit, then technically I'm recycling $3.50 of capital back into my account because it's the 5-point width of the spread minus the $1.50. That's $3.50 back into my account. Well, my original risk was $2, right? Because it was a 5-point spread. I opened it for a $3 credit. The difference there is $2. Now that I'm paying it back for $1.50, I'm bringing $3.50 of capital back into my account. Once again, that's that $2 of capital I put into the trade plus the $1.50 of profit I locked in on it. With net credit trades, You also have the option to let them expire worthless for a full profit. And once again, that full profit, of course, is based on the net credit you opened the trade for, right? That's considered the full profit on it. Once settlement occurs, the capital will be put back into your account. So for those of you who are like me, who like to trade SPX because it's a cash settled index, once that day of trading is over with, they'll typically cash settle it out. They'll see where the price was versus your strikes. Because it's a cash settled index for SPX, that's why I like it. They'll literally do it down to the penny and put that capital back into your account. Of course, if you're doing this on something like Amazon or Apple, you do have the risk of assignment. So, keep that in mind. But if your credit spread, for example, let's say it's a call credit spread, everything moved lower, well, then that call credit spread is technically out of the money. It will end up being a worthless trade. So if you didn't, pay a small debit to close it back out, you can just let it expire worthless, and that full net credit, let's say it's that full $3, ends up being the full profit on the trade itself. So those are some of the rules just to kind of keep in mind and remember. Let's go ahead and talk about this now. For example, here is Kroger, right? So we're in a trade on Kroger, which has just been hanging out. I think for those of you who are following along, a part of me, depending on how we close today, is going to potentially close this out and just bring the capital back in because we're getting very close to the expiration. Because this is a long call, of course, that means we're going to have theta decay work against us a lot more quickly. The good thing here is that it's mainly in the money, right? That's why I'm still have been holding on as long as I have on this trade, because it's the 30 strike. We have $2.04 of capital currently still in this trade. So any sort of move back up to test the highs, which here's Kroger's chart really quickly. So any moves to go back up and test these highs that we were at just last week, around $33, $34 here, would bring this spread back into the money further. And because the majority of this is intrinsic value, should allow us to actually close out of this for a profit, right? Right now, we're just kind of hanging out with a small loss. But because we're getting closer, one of the things I might do is just close it out and move on to a trade in a chart that's kind of working a bit more. Or because I do like the intraday squeezes that Kroger is printing, we have one on a 30 and 60-minute chart as well. I might look to just roll this out and give myself more time going to the June monthly expiration. It will technically be after, it looks like, when it anticipates earnings. So that should also help prevent some theta decay. And as you can see, it's not that much more expensive out here. So it's just really about buying myself time, still a decent amount of open interest. So for those of you following along, that's what I might look to do on this trade. However, notice that I have a closing order set up for this currently, right? So I'm originally in, and let me actually just clear this out. So I'm originally in the 30 long call, right? I bought to open it. This is what my opening order looked like. It was a BTO, the 30 call, and this was, over 30 days ago. Now I want to close out the order. So I can, of course, do this from the position page, but let's just say you're here on the option chain. We're going to click the ask on that, or excuse me, the bid on that strike, right? Because we're selling to close it. And here's how I confirm that my closing order is correct. Down here, notice how it was originally a bought to open strike. Now it says STC, so sell to close. So it's a C. We know we're closing it. We bought to open the strike originally. We see the negative. Now, if I paid a debit for this, I know I'm closing out for a credit. We can see here the CR is showing a credit, right? We're overall increasing our cash buying power. So I'm not sure. I'm guessing this is showing my loss actually of what I'm taking here on the trade, because I'm in it for more. I'm about $1 off. So that makes sense. But notice how the cash buying power would actually be brought back into my account. And certainly when you click review and send, you can recheck everything on there and make sure that it lines up accordingly before you click it and go. So that's an example of a, single strike straightforward. Let's go ahead and go to SPX. So here I have a hedge trade on for this week in case we did start to see a sell-off in the market. It actually holds a small profit, so I might look to close it out. But it is the 2735, 2700. I don't know why it does that when it gets bigger. There we go. 2735, 2700, 2760 feet, 2665. This was a normal standard butterfly that was opened for a net debit, right? It was a 35 point with butterfly. And now I've set up a closing order. So the two wings that were originally bought to open are now sell to close, which we can see here. And the mid strike, which was originally sold to open, is now bought to close. Once again, because it was a standard butterfly and I bought this for a net debit, I am looking to close it out now for a net credit. If, let's say I was clicking on these strikes individually, right, and I accidentally click on my mid strike, notice how it says BTO now, right, bought to open. I know that, first of all, doesn't match up with my other two strikes, which are closing out, right? I know I'm not doing a reposition or a rollout to where I'm, rearranging my strikes here, or the expirations. So I know right away that, okay, this isn't actually the correct strike. I need to change that up. There we go, right? Now it's in line. Now it's bought to close, and it matches up. Once again, this is bringing a credit back into my account. As you can see here, it's not much of a profit I'm taking on this trade right now, which is why I'm not going to be taking any action currently. Like I said, it's a slight hedge trade in case we do really start to sell off here. And SPX going into May, which we've seen a little selling off, but not a lot. So that is what I have set up for this week. But as you can see, this closing order is all set up accordingly, right? So sold to close, bought to close, sold to close, net credit. In our alert section, because everything here is overall giving me a net credit, at the start of the alert, it will say sold. So let me pull up an example. So here, for example, was a sold order on a target spread. Now, this is usually copied and pasted straight out of Thinkorswim. So that way, for those of you who want to, who have Thinkorswim, you can literally just copy this part of the alert, paste it in there, and it should line up with your strikes accordingly. Please always make sure you double check though, so that the order is correct. But so you know how to read the alerts as well, because I was closing out of what was naturally a debit spread, and I'm now receiving an overall credit for it. I am selling the trade overall, right? It's being sold. So I sold it. Overall, it's a -1, right? Because the two contracts combined, it's a one contract trade, 1-1 on each strike. And because it's being sold, it's showing a negative. This was on target. This was the March 6th expiration 106-103 put. It was for a $1.80 net credit, right? So once again, because it's a net credit, you know that the original trade was a net debit because I am closing it out. This is to close for the order, right? So it's not being opened, it's being closed. And of course, if you want that clarification, typically we try and put a note with the order, right? We try not to just send out an order automatically. Maybe sometimes we're in the room and we're talking about it, and we're just trying to get it out there. But typically, most of us traders here at Simpler Trading will leave a little note with it right in the alert section. So here we can see target has followed through with the bearish divergent bar nicely. I modified the good till cancel to protect capital and got filled instantly. If you decide to continue to hold the trade for a better profit, understand that it expires today and what your risk is, and may the trade be with you, right? Fits perfectly for today. So as you can see, closed it out for net credit. I'm talking about holding it for a better profit. You kind of get the mindset there. Jack, right below me on that same day, ended up buying to open a +1 trade. So notice how he bought to open a trade. On the strikes, it's going to match up to be a one contract trade. This was on the 6th of March. It was SPX. It was the 2945, 2960, 29.75 call butterfly. So we know if it's an overall one contract trade, butterflies are typically set up 1, 2, 1. So that's how that should look. And overall, call butterfly for the end of day today, a 180 debit. So you can see that he's paying a 180 debit. If it's a standard butterfly, it's typically opened for a net debit, right? As we've discussed in that video. So he's buying to open the trade for today. He's also mentioning in his notes that it's a low risk, high reward for an intraday trade into the weekend. So there are a few clues there, right? It's a low risk, high reward. So he's talking about how the setup of the trade works. That typically means, that he's going to be opening it to another clue there. And also notice how he's saying for an intraday trade. So if you do not intraday trade, maybe you've used up your day trades or you just have a small account and you don't like to waste them like that, then you know that this might not have been a trade that you jumped into because you wouldn't plan to intraday trade it. For those of you who have an account where you're able to day trade and not have those limitations, or maybe you wanted to use one of your day trades, then you know his plan set up already that he plans to open this, but also close it within today. So there are some examples there on the alert section. Now, typically, we'll still try and alert out something, right? But if we are letting something go into expiration worthless, whether it is a trade, maybe a credit spread that worked for us, or a trade that worked against us, right? If it was a debit spread that completely moved against us, which we have unfortunately seen, right? We don't like to. But typically, you might not see an alert follow through on that, right? Because there is no technically closing order. We're just letting it go and expiring worthless. Now, it doesn't mean that the trader hasn't talked about it in the room or during their session, right? But I will just make that note as of now that usually we'll try and mention something, or we'll try and put something in the alert section saying, hey, I'm letting this go to expire worthless, and then have like a little note about the trade with it. But otherwise, any action that we take, whether it's opening a trade, whether we're managing a trade, whether we're closing it out, if it is a trade that we started off with on the open of that trade alerting, we will follow through in the alert section and keep you guys updated on the action that we take, right? We won't just let it go and then be like, good luck. And of course, if you want to take your own action, please feel free to do so. You got to do what you think is best for your account. But there you go. And Lee, so Lee mentions that he's heard that you want to get out of some credit spreads when you've gotten 80%, get out at 20%. That's definitely not a bad rule of thumb if that goes with your trading plan. That way, in case the price reverses against you or something like that, you don't have to worry about that risk being out there. I personally kind of like to do the same thing. Even if it's gone completely out of the money and worked to my favor, sometimes I'll still close it out for, those 5 cents to close out of the trade, or a few pennies, just because, especially if it's a symbol where I have a risk of assignment, it just gives me that peace of mind. Yeah, exactly. So don't feel bad if we, say that it's going to expire worthless. We still try and mention it in the alert section. I know Henry does a good job of, saying he's letting a credit spread typically go into the close and cash settle or something like that. But definitely, if you haven't seen an alert gone through and you're wondering about it, a good place to go is into the actual archive section for that trader and kind of rewatch their session. I know for the majority of the trades I'm in, unless I'm really not taking any action and I don't see, a need to address it, it's doing what it's doing. I'll typically talk about it at the start of my session. So, you can just keep towards the start of the session and see if we've talked about it or anything like that. But otherwise, another great feature here, guys, of course, is, sorry, it's slight inception. But if you click on the little wheel icon, you can, for example, type in my name if it was a little alert that you were looking for from me, click enter. And all of a sudden, and click enter. There we go. And all of a sudden now, anything that has a mention of me, so Mandy's been putting these out in the morning, and because it starts with me, she mentions my day, right? So you can see here, those alerts come up, but you'll also see the ones from me as well, right? So, and typically in the main room, when you do that, It's usually the person's alert unless somebody else is talking about them in alert who will pop up there. Or if you know it's a trade, like for example, our target one, if you know it's a trade like that on a specific symbol, you can type it in, search for it, click enter, and then you can see here were all the recent alerts where I talked about target for trades that I had, right? And then if you just exit out of that, it resets. If you click the wheel again, that box goes away, and now you're back to normal alerts. Vincent. So Vincent, good question. If one strike is in the money and one is out of the money and you can't get it sold, then it expires and your account can't handle the action for the in the money strike. Is that a conversation with your broker? It certainly can be. Typically, though, your brokerage platform will be keeping an eye on your trades just like you are into expiration. And if they know that you can't handle it, they will force the trade out. So typically, even if one is like, let's say, out of the money and worthless, it's usually, like let's say it's a debit spread, it's the sold to open strike. So they'll, give it some value. It might not be as favorable a fill as you want necessarily, but they will force it to where it closes out of the spread. And vice versa. Typically, you can force it out by paying less than what the market is saying if you're concerned about it closing partially in the money. So I don't usually run into that case too often where one strike is offsetting the other. And the only time that I would kind of run into that is more so on a calendar or a diagonal, which in that case, the one that's typically in the money is your long strike, and you don't have to worry about that because that should have more time on it compared to the short strike. If it's a vertical spread, there's usually, not an issue forcing the trade to close out, even if one is appearing like it's worthless. It just means that you're probably closing out for less of a credit, right? Less of a net credit or less of a profit if it's a debit spread. And then Cookie Monster, real quick, is there a quick way to figure out whether to exit out of a debit spread or turn it into a butterfly if you can do both? Yeah, so if you're talking about the profit recycling strategy, if that's what you're referring to here really quickly. So let's say, sorry, I'm trying to set one up here now on SPX. So let me just close out of this really quickly so we can even see where SPX is. So SPX is looking overall bearish, right? So let's say we were in a put debit spread. We're in the 28.15, 28.10 for a 2.15 debit. Now you can look to close out of the trade, right? Make sure that your 28.15 is being sold to close, your 28.10 is being bought to close. But if you're trying to profit recycle it into a butterfly, what thing you would do instead is the strike that you sold to open, you would continue to sell to open. Let's say I'm in one contract on the debit spread side. So in this case, I want one contract here and here on the credit spread side. Because I technically hold the debit spread for, let's say, $1.10, and now I'm opening this credit spread for $2.10, just to keep math simple. That means technically speaking, it's $1 credit on a butterfly, which, as we know, when we open all three strikes together, all four contracts, it is technically a debit style trade. So in that case, that is how you can lock in the profit. And then now you have kind of a free trade out there with an extra $5 profit potential on top of the dollar credit that you've locked in. And then if you were to go the next day, for example, and close out of this trade, then whatever net credit that you close it out for, because keep in mind, you're still selling to close the two wings, buying to close the mid strike. So it's going to be for a net credit because that's standardly a net debit style trade, right? We just got it for a credit. And now in this case, whatever credit you close it out for will be an additional profit. Notice how, because this has time and the volatility and everything else, this is hopping around, showing a slight net debit. Typically, your brokerage platform would not even allow you to close this out for a net debit. But keep in mind, this is what you check, right? If I know that this is a standard butterfly that I paid a net debit for, there's no way I'm going to close out for a net debit. That's just giving them more money. I rather let it expire at zero and just take the full loss, right? Because if I'm paying money for them to take it back, but I paid money to open it, that's just giving them more money that I don't need to do. Have a great day, guys. Bye.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me.